Yesterday we have completed this problem. Now we'll come to calculation of yield. In case of bond or debenture, the investor wants to know what is the rate of return he is earning. So for that he calculates yield. How to calculate yield? If it is a coupon bond, then what is coupon bond? It pays coupon periodically. Maybe annually or semi-annually, and the principal amount is redeemed on maturity. Principal may be redeemed either at par or premium or discount. If nothing is given, you assume redemption is at par. For coupon paying bond, you can apply the formula. Which formula? Suppose assuming face value is 100 rupees, then take coupon rate plus redemption value minus purchase price divided by number of years or period of holding upon redemption value plus purchase value upon 2. But in case of other instrument where the amounts are paid in installments, it's not a coupon bond. Calculate IRR IRR can be applied for any type of problem. Find out that discount rate at which PV of cash inflow is equal to PV of cash outflow. That is the YTM. It means this is the rate of return the investor is expected to earn if he holds the bond till maturity, yield to maturity. Rate of return is expected to earn if he holds the bond till maturity, and this is the another name of IRR. So next point is how to determine the value of a bond. Value of a bond is the present value of future cash flow generated by the bond. Okay. Value of the bond is the present value of future cash flow generated by the bond, discounted at a rate of discount appropriate for the type of risk. Is it right? So YTM calculates rate of return earned by the investor based on the given price. Bond price is the amount of the bond that should be there in the market, taking into account the required rate of return. If you are given required rate of return, use that as a discount rate and find out the bond price. If you are given the current market price, use that to find out the YTM. Okay. Bond price depends on a number of factors, such as the ability of the issuer to make interest and principal payment, and how the bond is collateralized. That means risk involved. It will depend on the credit rating of the company, because if credit rating is good, discount rate will be low. If credit rating is poor, discount rate will be high. Several factors may be considered while deciding what will be the appropriate discount rate. So an across the board factor that affect bond price is the level of the prevailing interest rate. So generally, which discount rate we use? What is the ongoing interest rate on a similar bond? What is the ongoing interest rate on a similar bond? If you want to issue a AAA rated bond, what is the coupon rate on another AAA rated bond? That can be used as a basis for doing the valuation of a bond. So one small practice we will do on bond valuation. Solve in the question book only. This is a question. Consider a bond of XYZ Limited with the following features. Face value 100 rupees, coupon rate 12%, years to maturity 5 years, Find out the value of the bond if the required rate of return is 12%, 14%, 10%. So first one I will solve for you. Calculation of value of the bond if the required rate of return is 12%. First column year 1-5 cash flow. How much cash flow each year the bond will generate? 12 rupees. And on fifth year 100 rupees. Take discounting factor at 12%. How much? 3.6047. And for fifth year only 0.5674. Very good. Multiply. Take total. So it should be 100. Make it 100. Even if it is not 100, make it 100 because discount rate and coupon rate are same. Redemption is at par. So therefore, the answer should be 100 rupees. Try 14%. Try 14%. First tell me the discounting factor for 5 years at 14%. Yes, 3.4331. 41 point something 20. Calculate the factor here 0.5194. 51.94. This answer has to be less than 100 rupees. You have learned 93.137. You have learned that if discount rate is more, value of the bond will be less. Value of the bond will be lower than face value. Now one more question you try where the discount rate is less than the coupon rate. Try yourself. This time you will try. So what is the factor you are getting? Just check. 3.7908 for fifth year only. 0.6209. Multiply. Take the total. It should be more than 100 rupees. 107.58. So the question can be if the discount rate is less than coupon rate, the present value will be more than face value. True or false? True. If discount rate is equal to coupon rate, present value of bond will be equal to face value. True. If discount rate is more than coupon rate, present value will be less than face value. True. So these are the some basic fundamental features of a bond which can be asked in this chapter also. So dear student, please read bond valuation chapter. Before you appear for this exam, read bond valuation chapter because in your study material of the institute, problems are not given, but in the exam, questions are asked. Okay. Dear students, solve the next question. A bond of rupees 10,000 bearing coupon rate 12% and redeemable in 8 years at par is being traded at rupees 10,600. Find out the YTM of the bond. This YTM formula first you write down if you know. Write the YTM formula. After writing the formula, solve. I will give you the formula on the screen. C means coupon plus face value minus current price upon number of years upon face value plus current price divided by 2. The logic of this formula we have covered in SFM batch. So right now we will not go into that detail. Huh. 10.92%. Let me check. 10.92% is the right answer. Just check the answer on the screen. Do you agree with this? %10.92% was right. If the present value of the bond 10,600 is more than the face value, discount rate will be less than coupon rate. Discount rate, which is my answer 10.92, should be less than coupon rate. So that mentally you should have known before solving that my answer will be less than 12%, because this bond is trading at a price above its face value. Then start solving. Okay, now there is a question in your book, illustration 3, which is printed in the book only. Even solution is printed, so you don't have to write. Suppose an 8% rupees 1000 bond had 5 years left to maturity when it was purchased for rupees 800. When it was purchased for rupees 800. What is 8% here? Coupon rate. What is 1000 rupees here? Face value. What is 5 year maturity? And what is 800? The market price. The prevailing interest rate on other investment vehicle was about 8%. Further, assume that the current prevailing interest rate are about 9%. When you had purchased it, that time the rate was 8%, but now the rate is 9%. Why should, to test your intelligence, why should investor buy a 5-year-old bond yielding 8% when they can buy a newly issued 9% bond? Suppose if you want to sell this bond, he will not be interested, because he will say this bond will give me only 8% coupon. Other bonds are now giving me 9% coupon. So how can you sell a bond which gives 8% coupon when other bonds are giving 9% coupon? It means you have to increase the rate of return to the investor. How can you increase the rate of return to the investor? By issuing the bond at a discount. By issuing the bond at a discount, or you sell the bond at a lower price. Huh? No, premium you can't do because you are an investor. But you can sell the bond at a lower price, which will give the other party, the buyer, a higher rate of return. Like we saw in the first question. If the rate of return is high, present value of bond is less than face value. So I will have to sell the bond at a discount or lower price, so that it increases the rate of return for the investor. Is it right? This much you have to write in the exam. Now I will just read the solution quickly, but what you have to write, the only way, this much is enough, the only way the holder of an 8% bond can find a buyer is to sell the bond at a discount, because if you reduce the price, effective rate of return will go up. Okay, so that its yield to maturity is same as the coupon rate on the new issues. Now some explanation is written, which if you want to write in the exam, write. Otherwise this much answer was enough. Let us say interest rate increases from 8% to 10%. With 15 years to maturity, an 8% bond has to be priced so that the discount when amortized over 15 years has a yield to maturity of 10%. Now the explanation is very different from the original question. In original question, 5-year was maturity period left. Here they are explaining with a 15-year example. This is ICI. In the original question, the interest rate has increased from 8 to 9%. And they are explaining with the help of 10%. Is it right? ICI. C stands for confusion. Yes or no? They think big. But the student also become very big by the time he passes the exam. Now, this discount is little under rupees 200. Anyway, you don't bother about this. I'll just go through it. Read this paragraph as homework. In fact, what you should do in this previous question, your answer should be the bond should be sold at, right? The bond should be sold at. This bond will pay 8% coupon for 5 years. So 8% of 1000 means 80 rupees into PV annuity factor for 5 years. At what rate of interest? 9% I will discount. So that it will generate a return of 9%. And then 1000 into PV factor 5 years, 9%. So dear student, you should say, in order to match a 9% bond, this bond should be sold at falling price. Do you have calculator? Calculator. What is the factor of 5 year and 9%? 3.88. 3.88. And this is 1000 into only 5th year factor. Point something. 65. Bring calculator also. Seems like a theory subject, but I will introduce problem. Huh? How much is this one? 80.3.88 plus 1000 into 0.65. Final answer is 900. How much? 960.40. You should simply write that this bond should be sold at 960.40. Is it right? So that the rate of return to the buyer will also be 960.40. Some explanation is printed in your note, which you can read later as homework. They are also saying the same thing. If you want to increase the rate of return on a bond, it should be issued at a discount. And with some different example, they have tried to explain this point. Okay. Now in your notebook, write a small note. One more question. Dirty price and clean price of the bond. Bring notes, bring a notebook, bring calculator every day. Today I am going to dictate some notes also. Dirty price and clean price of the bond. Have you heard? Explain. Dirty price is cum interest price and clean price is ex interest price. If I remove the interest accrued from dirty price, it becomes clean price. The concept of clean price and dirty price arises when you have to value a bond between two interest payment dates. Suppose a bond pays interest on 30th June and 31st December, twice a year. And then there is a transaction of this bond on 1st September. So some interest has accrued from 30th June to 1st September. Is it right? So there can be two values of this bond on this day. One is without considering the interest accrued, that is ex interest price or clean price, and one is after considering the interest accrued, which is cum interest price or dirty price. Okay. This type of question is little difficult to solve unless you have done the practice. So I will take one practice. In SFM, you must have done many more questions. Okay. So you are requested to solve few more questions from SFM book. What is dirty price? Dirty price of a bond represents present value of all future cash flows. Present value of all future cash flows associated with the bond and includes interest accrued on its next coupon and includes interest accrued on its next coupon and includes interest accrued on its next coupon. Is it right? So it represents the present value of all future cash flows associated with the bond and includes interest accrued on its next coupon. Clean price. The dirty price of a bond less accrued interest is the clean price of the bond. The dirty price of a bond less accrued interest is the clean price of a bond. So mathematically, clean price equal to dirty price minus accrued interest. Dirty price minus accrued interest. Sometimes they may ask you to find clean price. Sometimes they may ask you to find dirty price. Dirty price is clean price plus accrued interest. Then your question will be how to compute the accrued interest. Go back to your happy, peaceful, intermediate days. Suppose there are two coupon payments, 30th June, 31st December, and the transaction takes place on 1st September. Interest accrued will be counted from last interest payment date till the date of transaction. Because with every passing day, the interest keeps on accruing on a bond. It is paid on the fixed date. So during this period, interest has accrued. In our example, it will be July, August, 2 months. Is it right? So after computing dirty price, which I am going to tell you how to do it, remove the interest accrued for 2 months. Because dirty price includes interest accrued. Clean price excludes interest accrued. Now what is the concept of dirty price and clean price? These are two ways of quoting a price of a bond. Two ways of quoting the price of a bond. In some markets, the prices are quoted on come interest basis. In some market, the prices are quoted on X interest basis. It becomes the convention of a market. Is it right? When you go to buy a movie ticket, do they charge GST separately from you? No, it is written 300 rupees, you pay 300 rupees. GST included. Yes or no? But suppose you eat in a hotel Marriott and then they will give you a food bill which will say 2500 rupees plus tax. So one theatre company is charging you including tax, one is charging you excluding tax. Tax will be paid separately. In both cases, you have to make the same amount of payment. But one quotes excluding interest, one quotes including interest. Many markets follow clean price because dirty price will change almost every day. Because every passing day means interest will get accrued for one more day. So therefore, to keep less variability in the price of a bond, many markets follow clean price method. Just like many companies sell on basic price. This is the basic price plus GST. If GST rate goes up, your total will go up. If GST rate comes down, your total will come down. But those who quote including GST, they have to revise their prices every time whenever the GST would change. Is it right? Anyway, that was some extra knowledge, not required. The dirty price of a bond, right, changes regularly. The dirty price of a bond changes regularly due to accrued interest. Due to accrued interest. Whereas the clean price of a bond is more stable. Clean price of a bond is more stable and thus is generally used in markets to code the price of a bond, and thus is generally used in markets to quote the price of a bond. Now I'm going to take a small problem. Is written. Write one small question on calculation of clean price and dirty price of a bond. In case if you have already passed SFM many years ago, it will help you to revise. Example, face value 1000, coupon rate 14%, coupon payable annually on December end. In the exam they can ask semi-annual also. Basic methodology will remain the same. If the coupon payable is on December 31st, valuation date is 1st April 2010. On this date you have to do the valuation of the bond. Maturity date of this bond is 31st December 2022. Maturity date is 31st December 2022. Required rate of return is 16%. Find out the full price. Full price means come interest price. Dirty price. Find out the full price that should exist on 1st April 2010 and split it into accrued interest and clean price component, and split it into accrued interest and clean price component. So you have to answer all three things. What is X interest price, what is interest accrued, and what is come interest price. So we'll revise your SFM question on this. Okay. Will you be able to solve? Okay, first you understand this timeline. There are 4 important dates in this problem. First date, write 31st December 2009. This was the last time in this question when the interest was paid, last interest paid. Up to 31st December 2009, the coupons have been paid. Between coupon date and valuation date, there are 3 months. What is the second important date in this timeline? 1st April 2010. This is the valuation date. We have to find the value of the bond on 1st April. If they would have asked 31st December, it was very easy, 9, or 31st December 10 also, it would have been easy. But between two dates, if they ask, some extra efforts will be required. Next interest payment date is 31st December 2010. So between valuation date and next interest payment date, we have 9 months. And maturity date is 31st December 2022. So how many more coupons will be paid after 31st December 2010? 12 years. Means 12 more coupons will be paid. Yes or no? You can count 2013, 14, 15, 16, 17, 18, 19, 20, 21, 22. No. Yes. 140 rupees coupon will be received 12 times after this date. And of course, this coupon is also pending. On maturity date, you will receive not only the coupon, you will also receive the face value. On maturity date, we will receive coupon plus face value. Now what I'll do, first I'll tell you the steps that will follow, logical step. First we'll find the value of the bond on this date, like a normal question. Compute the present value of remaining coupon plus principal. So this will give you the value of the bond on 31st December. But this coupon is also pending. So I will add that coupon also. So that will give me dirty price of the bond on 31st December 2010. Then I will calculate the present value of that, because I have to move 9 months behind, 9 months backward. So whatever value you will get, discount it for 9 months. I'll tell you how to do it. Normal present value calculation, future value upon 1 plus r to the power n. Here n is 9 months, 9 by 12 years. Okay. So you will get the value here. The present value of this dirty price will be the dirty price on 1st April 2010. Remove the interest accrued for first 3 months. Remove the interest accrued for first 3 months. That will give you X interest price. Okay. So right, 4 steps I'll follow. First I'll find out the clean price on 31/12/2010. I will add one interest coupon also. Then I will compute the present value. I will remove the interest accrued for 3 months. So I will give you the formula. You have to solve and give me the answer of clean price on 31st December 2010. 140 into 140 is coupon. It's an annuity for 12 years into PV annuity factor 16%, 12 years. Plus 1000 into PV factor, plus 1000 into PV factor 16%, 12 year. 5 seconds will be given to you to solve. 5 seconds only. Solve. Let us see who gives me the correct answer. 896.1. Right answer. 896.1. Okay. Everybody got it? So we are here right now. But does it include the coupon which is due on 31st December 2010? No. We have computed next 12 coupon. What you do, step 2, add the coupon which is due on 31st December 2010 also. So that will give me dirty price on 31st December 2010. The value of this bond including the interest will be 140, add 140 will be 1036.10. The value of this bond with interest on 31st December 2010 will be 1036.10. Okay, check the calculation. I'll go to the previous slide. Now again we are here and we got the dirty price. I'll move 9 months backward. I have to find out the present value of that number on 1st April. So using the formula of present value, future value upon 1 plus r to the power n. Step 3, dirty price on 1st April 2010. Dirty price on 1st April 2010. Dirty price on 1st April 2010. Take the future value, divide by 1 plus r. R is 16%. Number of years are 9 months. 9 months means 9 by 12 years. So now you are in trouble. 1.16 to the power 0.75. Yes or no? Do you know how to solve? Some students are now thinking how to solve this. 1036.10 upon 1.16 to the power 0.75 you are getting. How to solve power in fraction? So who knows this trick? Take square root of 1.16 12 times, something like this you have done in SFM. Then minus 1, then type minus 1, then into power 0.75 plus 1 multiply equal to 12 times, multiply equal to multiply equal to multiply equal to, and then you will get some factor. 1036.10 divided by that factor which you got just now on calculator will give you this number 926.95. Are you getting? Very good. What is this? This is dirty price. Full price. Write in bracket full price. That question was right. Find full price or come interest price. Whatever they ask you in the exam. Full price, come interest price, dirty price. On 1st April is 926.95. Last step. Step 4. They have also asked us to calculate the interest accrued and X interest price or clean price. So this amount of rupees 926.95, this amount of rupees 926.95 includes accrued interest for the last 3 months. Includes accrued interest for the last 3 months. That is 1000 into 14% into 3 by 12 equal to rupees 35. Equal to rupees 35. Okay. So how much is comes to? This is 35. And then write down clean price on 1st April. Clean price is also called X interest price. Remove that. After removing 35, your answer is 891.85 or 95. No problem. 891.95 is also welcome. Is it right now? Say yes. So this was bond. So we have covered two instruments of raising finance so far. Which two instruments we have covered? Shares and bonds. In shares we have covered equity and preference share. And then yesterday we discussed the theory part of bond, and today we took some numerical questions also. Basic question I have taken, more question you will practice from SFM. Now one important instrument of raising finance outside India is ADR and GDR. ADR is issued in America, that is by American Depository Receipt. GDR is issued all over the world, but not in America, because the moment you issue in America, it is ADR. If you issue in India, IDR, Indian Depository Receipt, that is also possible. So what is basically ADR? It is the equity share of a non-US company which is issued in America through a depository. Through a depository. Not directly, but through a depository, which is depository means a large international bank. So Indian company will issue share to the depository, and then depository will issue depository receipts to an American investor, and that is why it is called American Depository Receipt, which represent shares of a non-US company. Some Indian companies like Wipro, Make My Trip, MMT have issued, and I think Tata Motors also have issued ADR. So today your homework is you have to find out 10 Indian companies who have issued ADR. Will you do it? How? Google. Let me see. At least you will have to take efforts to write that. So your homework is to write name of 10 Indian companies who have issued ADRs. Okay. And ADR is like just nothing. It's like equity share issued outside India in a simple term for Indian company. And why do they issue ADR? Because they can raise huge amount of money. They can raise huge amount of money because Americans have deep pockets. Means their pocket is full of money, and they can invest huge amount of money if the company is good. Okay. And plus it brings lot of prestige and reputation also that your company is listed on a American stock exchange. You are exposed to sophisticated investors, and it gives lot of goodwill and publicity of the company's product and services also. So these are the reasons why Indian companies would go to USA to raise the funds. But of late the craze has gone down because Indian market itself have become very big and America has become very strict. Okay, compliances have increased, cost have increased. So therefore the craze which was there earlier to some extent have reduced. So what is ADR? ADR is a negotiable receipt which represents one or more depository shares held by a US custodian bank, which in turn represents underlying shares of a non-US issuer held by a custodian in the home country. So simply put, Infosys suppose wants to issue ADR or Wipro, they will issue share to custodian. Custodian is an agent of depository. Depository, he will inform the depository that the shares have been received, and then depository will issue depository receipts to the investors. So this is a procedure in simple terms. First, Infosys and depository will have to enter into an agreement or an arrangement that we want to issue shares in your country, but we can't issue it directly. We are a non-US company. So depository will say you issue share to this custodian. When the custodian receives the shares, it informs the depository, and then depository will issue depository receipts to American investor. And then these depository receipts are usually listed on the stock exchanges of USA, where the investors can trade in them. Why it is popular in USA? Because the investors have to comply with US regulation. He does not have to comply with Indian regulation. He does not have to open a bank account in India or a demat account in India or comply any of the Indian regulations if he want to invest in USA. Indian companies still have a lot of growth left in them. The possibility that prices would rise for Indian companies still very high. That is why it gives them a high rate of return also. US companies have matured. Now if you invest in many US companies, they may not give you a very high rate of return. So their share prices have already reached a peak. Recently in the newspaper it is written that Apple share prices have started reducing now. Okay. The market capitalization of Apple, which was $1,000 billion, has now gone down to around $816 billion. So roughly 90% is the erosion in the value of the shares of this big company Apple, right? Because you can't maintain a very high growth rate for a very long period of time. You start facing the competition. People start copying all your innovations. Cheaper products start availing in the market, and this is a world where people give lot of importance to the pricing. Okay, so therefore new companies still have lot of growth potential left, and that is why US investor take a bet. ADR is an attractive investment to US investor willing to invest in a security of a non-US issuer for the following reasons. So the question in the exam could be, what is the reason for American investor to invest in a Indian company? Or they will create a case study. You are an Indian company. You want to get yourself listed on the stock exchange. Why do you think American investor will show interest in your company? Okay. The first is ADR provides a means to US investors to trade the non-US company share in the US dollar. For example, you take you as an example. You may be interested in buying the shares of say Apple. Yes or no? Microsoft, Google, Facebook. Okay. Can you do it? Can you buy? Not easy. Because they're not listed on the Indian stock exchange. You can't buy in Indian rupee. Lot of complications may be involved before you can reach to buy those shares. So you'll say, let it be. I'll just buy Indian company share on. Yes or no? Same problem for American also. If he wants to purchase shares of Reliance Industries or Wipro or TCS, he cannot do it sitting in their country. But if the ADR of Reliance, Wipro, TCS is listed in US stock exchange, he can easily purchase them. Yes or no? If shares of Microsoft is listed in India, then I can purchase those shares easily. So therefore, first is it becomes easy for them to purchase a non-US company shares. ADR is a negotiable receipt issued in US capital market and stated in dollar. So another benefit is no conversion is involved because it is traded in their own country in their own currency. Is it right? So he does not even bother to convert into rupees or any other currency. It is traded in the US market means it gives them liquidity. Anytime he thinks that the company is not doing good, risk has increased, he can come out from his investment. He can sell in the US capital market. Most of these are listed on the US stock exchanges. Okay, that is the purpose, to have a visibility in the US market. When your company is listed, every day it will come on the television screen. Okay, all media will cover your company, mobile apps will cover your company. Okay, that means any device which shows the market trend will also show your company's share prices also. So it will give them visibility in the US market. That is why they get themselves listed on the US stock exchange. Trading in ADR effectively means trading in the underlying shares. So sitting in USA, he's trading on Indian company share. If the price of the share goes up, he will enjoy the return. Next paragraph, basic features of ADR. Depository receipts are listed on the US stock exchange. Yes, of course you have to do the compliances. Then the depository will not issue the depository receipt. We are assuming all the legal compliances have been completed. First, Indian laws you have to comply. Then US regulations you have to comply. And then finally you get the permission of listing on the stock exchanges. But I have seen in your notes, the notes does not contain the regulations of ADR, at least till now. Maybe in the last chapter, SEBI, if it is there something, I will check there. Okay. The benefit of issuing ADR or investing in ADR is that you can transfer the share in the US stock exchange, and therefore it gives liquidity to the investor. The transfer of ADRs automatically transfer the underlying shares. Understood? So this point number C, D, E, F. C, D, E, F, write down reason for investing in ADR. C, D, E, F. Point number C, D, E, F. Or you can write benefits to investor. Next question on the screen is, does transfer of ADRs involve any stamp duty? They are transferring in America. So if you transfer in India, then stamp duty is involved. Okay, but it is not involved if ADRs are transferred in American stock exchanges. So transfer of ADR will not involve any stamp duty. So another good reason for investing in ADR, transaction cost does not involve stamp duty. In which currency dividend on ADRs are paid? In US dollar. Okay. Dividends will be paid to the investors in US dollar. He will get in his bank account the dividend converted into US dollar. So Indian company will make payment of dividend to the depository, and then they will transfer it to the investor's account by converting into dollar at whatever is the rate of exchange at that point of time. Next is how to issue ADR. So this is written in your point number I, tick mark. Basic, very brief introduction, how to issue ADR. Suppose you are an Indian company, let us say you are Wipro, and you want to issue ADR in America. So first, Wipro has to work with its US investment bankers, because see, lot of marketing has to be done. Lot of marketing. Why? You are an Indian company, you are going to raise funds from America. If you go to America and ask 10 people, do you know Wipro? What they will reply? No, we don't know. Do you know Reliance? No, we don't know. So therefore, you have to take the help of these investment bankers who are well informed as to whom to target, how to promote, how to sell the securities, how to do marketing. They know the US market, they know their clients, so they can help in marketing of your stock share. Then you have to enter into an arrangement with US depository bank, like for example Citibank, Bank of America, Standard Chartered, whatever, whichever are the big banks in USA. Then you have to also ensure legal compliances. You had asked me this question. Both US and non-US legal counsel. You have to comply with Indian regulations, whatever Companies Act, SEBI, FEMA applicable to you, and whatever compliances are required in USA, which is very strict, as somebody had pointed out. Then you have to also get your books of account audited by a foreign auditor, and that financial statements have to be converted either as per US GAAP or as per IFRS. For companies outside USA, they have started accepting IFRS based financial statement. Earlier only US GAAP. Now they have started accepting IFRS also. Not India's. Hello, India's is not accepted anywhere outside India. Maybe Nepal, Bhutan, Sri Lanka, Zimbabwe, Pakistan also. I don't know. I can't comment. Imran Khan is my friend, so I will not say anything. Now, these are the compliances. Now, next is listing of ADR. Where is ADR listed? ADR is usually listed on NYSE, New York Stock Exchange, and NASDAQ. You write NASDAQ also. American Exchange, MX. You write also NASDAQ. I think that line will come below, so I am not writing here. Quotation on NASDAQ can also be used for trading purpose. So it's traded in NASDAQ also. If you get a chance to watch CNBC in English, then they will show you quotation in NASDAQ also. Or if you are traveling outside India, then if you see the CNBC channel or whatever foreign channel showing financial market, you will see NASDAQ, Infosys rate, Wipro rate, etc. sometimes appear on the screen. Then any requirement with respect to blue sky law, if not exempted, has to be fulfilled. Now in USA there is a law called blue sky law. What is blue sky law? Institute will not write, you have to search. So Indian companies have to also comply with blue sky law. Write down briefly below. Blue sky law is a state law Blue sky law is a state law in the United States that regulates the offering and sale of securities ostensibly to protect the public from fraud. Ostensibly to protect the public from fraud. That means the objective is to protect the US investor from cheating. Point number next is printed in your book. Have you noted what is blue sky law in USA? That means you have to comply with state laws relating to issue of securities. The objective is to protect the public from fraud. So again, these are very strict laws. Okay. We are not going to go into details of the blue sky regulations in detail, but These are quite strict laws, and then only you are allowed to trade. Specified document and information must be provided to NASDAQ. Okay, so your balance sheet, P&L account, and they ask for long list of documents and information. Then they will review the terms of the offering and determine whether the underwriting arrangements are fair and reasonable. The filing documents with NASDAQ are the responsibility of managing underwriter. So you have to appoint an underwriter in USA, generally these investment bankers, and they will complete all the documents related formalities. So this is how ADRs are listed. Now in the notebook or write somewhere ADR process, how this process works in 4 steps. Briefly, more detail you will learn not required, actually more detail. This much is enough to become CA. The domestic company, let us say Wipro. Suppose Wipro wants to get itself listed. The domestic company already listed in its local stock exchange, means in India. Wipro is listed in India, sells its shares in bulk to a US bank. A US bank means depository. To get itself listed on US stock exchange. To get itself listed on US stock exchange. Then step 2 right below, the US bank accept the shares of the issuing company. US bank accept the shares of the issuing company. Point number 3, right? The US bank keeps the shares in its security. The US bank keeps the shares in its security and issues certificates which in bracket ADRs and issues certificates in bracket ADRs to the interested investors through the exchange. Next line, right? Investors set the price of the ADRs. Through the bidding process in US dollar. So this is how the entire listing process is done. Investors set the price of the ADR through the bidding process in US dollar. Come to your book. Paragraph next, types of ADRs. Depending upon how much compliances you want to do, you can issue unsponsored ADR or sponsored ADRs. Okay, so first we'll divide ADRs into 2 types, unsponsored and sponsored ADRs. Unsponsored ADRs are issued without any formal agreement between the issuing company and the depository. although the issuing company must consent to the creation of the ADR facility. So this is without, underline, without any formal agreement between issuing company and depository. See, the practicality of this will be very less because you need to have a proper arrangement with depository, but this probably option is given to some company, some countries where they might be allowed to issue their shares in USA without any proper formal arrangement with the US depository. But to my understanding, this may not be open for Indian company. It may be for other countries with which America may be more comfortable. Okay. Huh? Close tie. Yes. Although the issuing company must consent to the creation of the ADR facility. Of course, you have to take the consent of this company before the depository issues the depository receipts. Unsponsored ADRs trade on the over-the-counter market. Write down. I think it is written. Just check. Unsponsored ADRs trade on. Write down. It's not printed. Later on, I added. Unsponsored ADRs trade on the over-the-counter market. Means not a proper stock exchange. Because investor in general will prefer to trade on a stock exchange only. But these are unsponsored ADRs, so they will trade over the counter market. And one more line you write, unsponsored ADRs are often issued by more than one depository bank. Sponsored is issued by only one depository bank. Unsponsored can be issued by more than one depository bank. Unsponsored ADRs are allowed to be issued by more than one depository bank. If they ask you distinction between unsponsored and sponsored ADR, these are the 2 points you will write. Why would some companies prefer unsponsored ADRs? Because one is there is no formal agreement, but there can be some strong reason. Regulation is less, cost is also less. Cost is also less. The cost of listing, compliances, etc. is lower in case of unsponsored ADRs. This I have written there. With unsponsored ADRs, certain costs like those associated with disbursement of dividends are borne by the investor. For the issuing company, they are an inexpensive method of accessing the US capital market. It's relatively low cost method of raising finance. A lot of costs can be reduced here, compliance cost, audit fees, listing fees. Okay, and then the cost of disbursement of dividend is borne by the investors. They are exempt from most of the reporting requirement of SEC. This is the reason, because SEC is a very strict regulator. They impose huge penalties and imprisonment also in some cases. Now come to second type of ADR, which is called sponsored. Sponsored, it means they must be properly, formally issued. So they are created by, underline, single depository. Unsponsored by more than one depository. Sponsored, underline, single depository which is appointed by the issuing company under the rules provided in the deposit agreement. So there is a proper formal arrangement between issuing company and the depository. Sponsored ADRs are also of two types. Restricted, unrestricted. Then your question is, what is restricted ADR? Restricted ADRs means restricted with respect to type of buyer which is allowed. That means they will be issued to only selected buyers. It is not issued to public in general. So they are usually privately placed. Privately placed means issued to selected group of investors. So that is restricted ADR. And the next is unrestricted ADR. There is no restriction with respect to buyer and are publicly placed and traded. So these are issued to anybody in USA. Anybody interested can purchase unrestricted ADRs. And then there are three classes of unrestricted ADRs. Underline, three classes of unrestricted ADR. Which are the three classes, right? Level 1, level 2, level 3. Level 1, level 2, level 3. Even unrestricted ADRs are of three types. Level 1, level 2, level 3. We will not go into the legal aspect of this. Only remember, level 1 less compliance, level 2 more than level 1 compliance, and level 3 has the highest compliance. Okay, so only one line is written in the note, each increasingly demanding in terms of reporting requirement of the SEC, but also increasingly attractive in terms of degree of visibility provided. If you want to issue level 1, compliances will be less, but your visibility in the US stock exchange will also be relatively less. But if you are willing to comply with level 3 requirements, compliances, then you get more visibility. You are traded in more places. More investors are easily approachable in level 3. If you are more interested, you can easily do the research on Google and you'll find what are the requirements of level 1, level 2, level 3, and what are the benefits of level 1, level 2, level 3 listing. Okay. Due to lack of time, we will not go into that detail because that is not there in your study material also. Is it there? Okay. Next question which I have added from my side. Advantages and disadvantages to the issuer of ADRs. Why would a company issue ADR and what are the disadvantages also? So advantage number 1, which we discussed in the beginning, you can access to a large capital. Large means really large. You want to raise say 50,000 crore rupees, 60,000 crore rupees, 1 lakh crore rupees. Indian market may not be sufficient to pay such a huge amount of capital to you, but then Americans have deep pockets. If the company is good, then probably they will be able to raise that funds. Second, you are able to raise the funds in foreign exchange because American investor would invest in dollar, and that foreign exchange is required to execute many projects in foreign country, to purchase capital goods, to purchase raw material, components, etc. So companies also get foreign exchange, which is again very important. And next is, as per the current regulation, ADR holders do not have voting rights. ADR holders are not given voting right. If they want to vote, they will have to convert ADR into the shares of company, but then they have to open a bank account and demat account and do the formalities. Okay. So even though they are issuing equity share outside India, there is no dilution of control. Buyback of ADR, I don't know whether there is a direct regulation, but it is like an equity issue, so therefore you can buy back. Okay. So there is no prevention also anywhere mentioned in the law. But for the company, it is an equity share. It will appear in the balance sheet as an equity issue. So I will again check, but basic understanding, whatever buyback rules are applicable in Companies Act and in SEBI will be applicable for buyback of ADRs also. Possible, but this is a good question which we have to again think about it. Can ADRs be bought back? That question is there. Then what are the disadvantages? Why Indian companies don't list on American stock exchange? Very few have listed, maybe some, not even 100. Is it right? Because cost of issue is very high and cost of compliance is very high. US regulations are very strict. So US lawyers charge you a very high fees. Merchant bankers charge you a very high fees. Listing fees is very high. Then you have to get your books of accounts converted into US GAAP or IFRS, audited by a CPA. Audited by a CPA who charges again high amount of fees. Normally sometimes they may insist on the audit by one of the big four groups company. Okay, PwC, KPMG. So their fees is also quite high. Disclosure requirements are more stringent. Lot of information have to be given about the company performance, etc., and which actually it means you almost give lot of business secrecy also to the public, right? One more point, write down. Any violation of compliance can lead to strict action by SEC. Any violation of compliance can lead to strict action by SEC. Indians know that they are not going to follow the law. Our culture is like, okay, we are embedded in such a manner, we are programmed in such a manner that we can't comply with the law continuously. After some time we get bored, we feel irritated if we are complying with the law. Yes or no? And when it comes to money matter, we just keep finding ways and means to make more money. So better not to invest in American stock exchange. Okay, go to Luxembourg stock exchange in some corner in Europe. Okay, where compliances are less, and at least you can say in your resume that we are a foreign listed company. That also is served. Now this paragraph I have added recently. If you want to write, otherwise we have discussed it earlier also. Advantages to the American investor. Some points I have covered earlier in basic feature of ADR. Some I have added today when I was presenting this, preparing this presentation. First advantage, write down, because this case study they will ask, why would an American investor invest in an Indian company? Okay, you are the CFO, you want to raise money in America, but MD says he is not convinced that American investor would invest in Indian company. How as a CFO you would convince him? So you will say the American investor can invest in foreign companies which can fetch him higher return, which can fetch him higher returns. Second point, write down, it is an easier way to invest in foreign companies. It is an easier way to invest in foreign companies as there are no restrictions to invest in ADR. as there are no restrictions to invest in ADR. Okay, right first. ADR simplifies tax calculations. There are some tax advantage also. ADR simplifies tax calculation. Trading in shares of foreign company in ADR would lead to trading in shares of foreign company in ADR would lead to tax under US jurisdiction. Will lead to tax under US jurisdiction and not in the home country of the company. And not in the home country of the company. So you don't have to pay TDS. Okay. No one will deduct your TDS. If you trade in India and then if you make profit, then there are TDS issues, withdrawal tax issues, etc. Point 4. Pricing of shares of foreign companies. Pricing of shares in foreign companies in ADR is generally cheaper. Now, generally cheaper means it is not always cheaper. Sometimes you will find there is a premium also in ADR compared to local market. But in case if it is cheaper, then it will provide additional benefit to the investor. So this way you have to write the case study that following will be the benefit to a US investor, and then write one more paragraph below that. Disadvantages. Disadvantages to the American investor. You are opting for a special subject, okay? So you have to also look at the issues from other angle. Why normally they don't invest? The number of options to invest in foreign companies is listed. The number of options to invest in foreign companies is limited. As I said in the beginning, not too many companies have issued ADR because of cost and high compliance and strict action by SEC. Only few companies feel the necessity to register themselves through ADR. Only few companies feel the necessity to register themselves through ADR. Second drawback is investment in companies opting for ADR. Investment in companies opting for ADR often becomes illiquid. As investor needs to hold the shares for long term to generate good return. As the investor needs to hold the shares for long term to generate good returns. Okay. That means you can make good amount of profit only if you are willing to wait for a long term, which means for that period your investment will turn illiquid. Okay. These are some disadvantages. Not very serious disadvantage. Now we'll take global depository receipt, but after a small break.